How much money does the average day trader make? The average day trader in the United States makes $116,000 per year, at least according to Zippia. Over at the Glassdoor, they say the average day trader makes $178,000 a year, but they include traders who work at prop firms and at trading desks, so that's a little different. Over at ZipRecruiter, they say the average self-employed day trader, that's me, and that may be you as well, makes $94,000 per year. What none of these three sites, which average salaries across this country, state is the success rate of becoming a trader, because we know the success rate is very low. Nonetheless, in this episode, what I want to do is I want to take that number, the average salary, I want to break down where those profits come from. Now, I'm going to use my own numbers as an example. So even though the total profit that I've made is a lot higher and is not typical, we're still going to use that just as this is the number and now that's our pie. So, okay, the big circle's a little bit bigger, but it doesn't matter. We're going to go and break it down based on a number of different factors. So what I'm going to do in this episode is start sharing with you where that profit comes from. Number one, time of day. The time of day that I trade is predominantly between 8 a.m. and 10 a.m. I have found that that is the window where I make the most money. There are some traders out there who trade power hour, which is from 3 p.m. to 4 p.m., who trade after hours, or who trade during the lunch hour. I even know some traders who just trade sporadically. When they have a few minutes, they just sit down at their computer and take a couple trades. But for me, I have found in my metrics that I make the most money between the window of 8 a.m. and 10 a.m. And so that's where 99% of my profit comes from. So that's time of day, day of the week. My profit predominantly is generated on Wednesdays and Thursdays. Now, I make money on every single day of the week, but I make the least on Monday, and then it increases from there. Why is that? That's trading psychology for you. Because I trade for income, my goal is to make money every single week. I understand I won't make money every single day, but I never want to lose more on a bad day than I could make on a good day, perhaps the next day. And I don't want to have more than one red day per week. So generally speaking, I try to be green every single week. And I start on Monday morning, fresh slate, new week, dipping my toe in the water, being a little bit cautious. If the market's hot, I lean in, I get more aggressive, I scale up until I peak on Wednesday and Thursday, and then I slow down on Friday to not risk giving back all my profit from the week. So we've got time of day, we've got day of the week. Now, in terms of accuracy, my accuracy right now is 68.9%, which means I'm wrong just a little over 30% of the time. I'm wrong all the time, you could say. I'm wrong a little bit just about every single day, and that's okay. You do not have to be right on every single trade in order to be a profitable or a fantastically profitable trader. You just have to know when to cut your losses and walk away. And I've gotten really good at that. Now, I got good at that because I learned the hard way that if you hold your losers, they get really, really, really big. And then you end up taking one loss that wipes out 10 or 15 winners. And it's just not worth it. So after doing that a few times, I learned you've really got to keep your stops as tight as possible. And it's better to just follow the philosophy of breakout or bailout. If it doesn't work right away, get out and get back in for another shot a little bit later. Now, let's talk a little bit about the specific stocks where my profits come from. I have found far and away that my profits come from stocks between $5 and $10 a share. That for me is kind of the sweet spot where I feel like I'm able to purchase a fairly large position, but where we also get good size moves and where I feel I can manage my risk. I have found on higher priced stocks, number one, I can't afford to buy as many shares because even though I've made a lot of money trading, I take that money out of my account. I don't just leave it all in the account. That's not good risk management. I take money out and then I keep just enough in there to trade every day. So when we see stocks that are $30, $40, $50 a share, I can't trade them with very much size. And even when I do, they have such large ranges that I found that I can take outsized losses, which really, for me, is a problem. So above $20, not great. My sweet spot is 5 to 10, but I do make money on stocks between 2 and 5, and I make money on stocks between 10 and 20. However, above 20 and under $2, not so much. And you might think, Ross, well, under $2, you could buy the most because they're so cheap. And while that's true, when it comes to day trading, I have found that those lower price stocks generally don't produce the intraday squeezes that I need. They're more of grinding stocks that people buy for bigger moves over the course of days. They're almost a little bit better for swing trading than for just day trading. And my metrics speak for themselves. It's just not where I make the most money. Now, this probably wouldn't surprise you, but I make the most money on the stocks that have the most volume. More volume means more liquidity. That means I can get in and get out with bigger positions. So when I'm looking for stocks to trade, based on my own metrics, I have a good sense of knowing what I want to look for. If I see a stock with very, very light volume, naturally, I'm going to be more conservative. When I see a stock with decent volume, I'm going to be a little bit more aggressive. But when we think about volume, there's different ways to look at it. One is the total number of shares traded on the day, and I make the most on stocks that have more than 25 million shares by the end of the day. But there's also something called relative volume, and that's the amount of volume today relative to what's normal for a stock. And so a stock that has high relative volume means that it has, for instance, 5 times higher volume today than its 14-day average. And the only reason that would really happen is when a stock has breaking news. Now, this is something interesting. There's a little bit of a curve here where I make a lot of money on stocks that have 5 times relative volume, and I make a good amount of money on stocks that have basically the same volume as the previous day, but is still 5 times higher than the 14-day average. This is a little complex. So if it's 5 times higher than the 14-day average, but it's the same as yesterday, what does that mean? The stock has been strong 2 days in a row. This is a continuation setup. So continuation, it was strong yesterday and it continues today. The relative volume is similar to yesterday, but both are 5 times higher than the previous 14-day average. So relative volume is a really important metric that I look at in my own trading, and I look at when I'm considering whether or not a stock is worth trading at all. Higher relative volume is better. When it comes to continuation stocks, sometimes they won't be gapping, which means they're opening higher than they closed the previous day, but a lot of times they do gap. Now, the first day of a move is when we see the biggest gap. The news comes out pre-market or after hours, and the stock opens significantly higher than the previous day. And so if we look at my profitability by the percentage of gap or the percentage gain, you'll see far and away it's on stocks that are up over 10%. I mean, that just makes sense for my strategy. And for what it's worth, I'm trading a momentum strategy, which is extremely popular. This is ultimately the strategy that a lot of traders use. We just all have somewhat different variations of it. Maybe we trade, a little bit differently, but we're generally doing the same thing. Now, the inverse of trading momentum would be counter trend trading, where you're trading reversals. You're buying stocks that are really, really weak, or you're shorting stocks that are really, really strong. One of the challenges for beginner traders is that you're getting in front of a moving train. You're getting in front of a lot of momentum trying to predict a reversal, and that can be a little risky. So the best way to do that is, of course, to leg in slowly rather than to go all in case your timing is wrong. But for most beginner traders, it's a lot easier to jump on an existing trend than to try to guess the reversal. Now, the metrics that I'm sharing with you come from taking over 24,000 individual day trades and producing just under $12.5 million in gross profit. My results are not typical. In fact, in the 72-month period that began on January 1st, 2017, I was averaging $144,000 of profit, not per year, but per month. That's audited. That is real money. You could check out my audit results if you want. I'll put a link in the description. But this is just to say my results are not typical, but I am just trading the same strategy that so many other people trade, but I've amplified it because I have such a track record that gives me confidence to trade with bigger size. That's really what it is. A beginner trader is going to trade way scaled back, smaller size, more conservative, fewer trades. As you gain confidence, you start scaling up. So your question may be, how do I become a more confident trader? And the only way you can do it is through experience. Keep trading, keep practicing, track your metrics, and go back to your metrics and try to improve your trading every single week, every single month, every single year. I hope you found this episode helpful, and I'll see you for the next one real soon.